What's up, everybody? This is Sunko, the Korean bro. Today is 2024, January 7th, and let's see what articles we have tonight. Beyond the Hype Tree Growth Stash won to miss in 2024. Rivian, Haxos, Fluence, Rivian, Haxel, increasing airplane production and composite content augur well for Haxel. Boeing, Airbus, and other airplane manufacturers are looking for any way to ramp production and deliver on multi-year backlogs. Uh, it isn't easy. Boeing is set to miss its target for 737 MAX production in 2023 due to a manufacturing quality issue. Still, there's no doubt airplane manufacturers need to increase output. That's great news for a supplier like Hexel. The company's advanced composite materials have strength and weight advantages over conventional materials like aluminum. They are an integral part of the future of the aerospace industry. At least that's how Boeing CEO Dave Cahan sees it. Okay. There's stocks that could create lasting generation wealth. Amazon Mercado Libre. Okay, let's look at Mercado Libre and Amazon in detail, okay? Hmm. Okay, here Amazon is the world's largest e-commerce and cloud infrastructure company. It sells of ads across its own e-commerce marketplaces, website, and streaming media platforms, also make it one of the world's top advertising companies. Over the past 20 years, Amazon stock has risen 5,470%. The growth was initially driven by the expansion of its e-commerce platform, but its platform Amazon Web Services also grew over the past decade as its higher margin revenue turned it into the company's core profit engine. The expansion of AWS and its higher margin advertising business could also offset these lower margins of its e-commerce marketplace and brick and mortar stores for the foreseeable future. With a market capitalization of $1.5 trillion, Amazon probably won't replicate those massive gains over the next 20 years. It also faces a lot of competition in the e-commerce market from smaller challengers like PDD's Temu and Shein, while Microsoft remains a formidable foe in the cloud infrastructure market. Despite all those challenges, I believe Amazon remains a great stock to buy and hold for the next few decades. It takes scale to survive and thrive in e-commerce and cloud markets over the long run, and Amazon continues to squeeze profits from both businesses as many of its smaller competitors burn out in this challenging market. Okay. Hmm. Bull market skimming. Okay, here we have Palo Alto Networks is a leader in AI-powered cybersecurity. Duolingo is using AI to transform language education. Okay. Is the largest language education platform in the world. It takes a digital mobile first approach which places an interactive and engaging learning experience right in the pocket of its 83.1 million monthly active users. Despite economy headwinds in 2023, like elevated inflation and rising interest rates, Duolingo consistently beat its own financial forecast, which led to a 219% gain in stock price. Hmm. Okay. Last time Apple spent this much money, it unleashed 20 years of unstoppable growth. Apple spent nearly 8% of its total sales on research and development last year, the highest in 20 years. CEO Tim Cook says the company is investing in many things, some of which are top secret. But it's the known investment, including AI, that are having the biggest impact on the stock right now. Spending on research and development has nearly doubled to over $29 billion in the last 5 years. What is Apple up to? Apple stock finished 2023 up 47%, but the shares have slipped about 4% in 2024 so far. Wall Street is nervous about slowing iPhone sales and weakness in China, where the company generates one fifth of its sales. Stock finished 2023 up 47%, but the shares have slipped about 4% in 2024 so far. Wall Street is nervous about slowing iPhone sales and weakness in China, mm, where the company generates one fifth of its sales. But Sonic is cooking in Cupertino, California. Apple spent 7.8% of its total sales last year on research and development expenses, or nearly $30 billion. That's the highest percentage of its revenue in 20 years. Around the time when the tech titan was expanding its iPod and music businesses and developing the first iPhone. Apple's R&D has been steadily climbing over the last decade, but there hasn't been a major new product since the Apple Watch in 2015. The new Vision Pro is coming this year, but the company hasn't made any significant changes to the design of its existing product in years. So when we look at where Apple is investing its cash, it may not necessarily point to lots of innovation on the product front, but it could still have a major impact on Apple's returns to investors. Apple is widening its competitive moats. When asked on the company's fiscal fourth quarter earnings call, CEO Tim Cook explained that the increase in R&D is going toward a lot of things. Some things I can't talk about. It's Vision Pro. It's artificial intelligence and machine learning. It's silicon investment that we are making. The transition with the Mac and other silicon. The silicon he is referring to is a transition away from an Intel processors to its own chips for Mac, other products. Apple has invested for many years in artificial intelligence and machine learning, most notably in the Siri voice assistant. Cook hinted that there's more going on, but that could mean many things for Apple's product development roadmap. The problem is that Apple is a gigantic company with $383 billion in annual revenue. When the iPhone was first released in 2007, Apple was a fraction of that size. So the days of releasing a single device that moves the needle and send stock to the moon are long gone. Overall, the old things Cook mentioned are going toward widening the company's competitive moat and building a more profitable business. This explains why Warren Buffett continues to hold a massive stake in Apple stock, and why investors should consider holding shares too. Apple's investments are creating enormous shareholder value. Apple's not releasing groundbreaking new products that change the world, but it's enjoying a strong profit margin that is starting to trend toward record highs again. This is why the stock climbed 47% in 2023 despite lower sales. High margins can be traced back to the company's boost in R&D spending. So Cook mentioned some of the R&D increases going toward AI. This technology is the backbone of many features on the iPhone, including Siri searching photos, Face ID, and neural engine that enables the iPhone's camera to capture better images. These features raise customer satisfaction and spending on services, which generate twice the margin of hardware products. Services including sales from apps and subscriptions is Apple's fastest growing business, expanding 9% year over year in its fiscal 2023. Management clearly sees more growth for services over the long term. Our installed base of over 2 billion active devices continues to grow at a nice pace and establishes a solid foundation for the future expansion of the ecosystem. So, because services still only makes up 22% of Apple's total sales, and it's growing faster than other sales categories, margins and profits should remain on an upward trajectory. Management is direct investment at the head of Apple's competitive advantage, which is its brand and user experience, and that spells rising profits and dividend increases, as well as a stock that should be hitting new highs for years to come. The Buffett test. Okay, determine if you can sensibly estimate earnings range for 5 years out or more. If the answer to the first step is yes, but the stock only if its price is reasonable compared to lower or of the estimate earnings range. Dutch Bros. The Nasdaq will soar in 2024. One superb stock split stashed by before it does. Okay, here we have. Okay, what a difference a year makes. After the Nasdaq accomplished had 33% of its value in 2022, one of the worst market performance in over a decade. Uh, the index has nearly returned to its former glory, closing the door on 2023 with a gain of 43%. History offers a hint about what could be ahead in the coming years. Since it first began trading in 1972, and every year devolved a bear market rebound, the tech-heavy index has continued to rally, gaining 90% on average. While there are no guarantees in investing, this suggests the current recovery has more room to run. So one strategy investors use to find winning stocks is to look at companies that have conducted stock splits in recent years. As those moves are historically preceded by years of rogue gains, one such company is Nvidia. Over the past decade, the stock has generated total returns of 12,780%. So resulting in a 4-for-1 stock split in mid 2021. The chip maker low gains of 239% last year, which has some investors concerned about its valuation. However, a little digging will unearth evidence that the stock is cheaper than it might be some measures appear. The AI catalyst. Recent advances in the field of artificial intelligence have been a boon for NVIDIA. More specifically, generative AI went viral last year, and those algorithms have been applied to a wide variety of mundane, time consuming tasks, resulting in a greater productivity. Increased efficiency generally results in greater profits, and businesses have been scrambling to integrate AI models into their operations to benefit from the expected windfalls. So why does this matter to NVIDIA? In short, the company produces the gold standard of graphics processing units, which can not only provide the computing power necessary to render lifelike images in video games, but can also supply the computational horsepower necessary to support AI systems. This is all because possible because of parallel processing, which takes computationally intensive jobs and breaks them down in smaller, more manageable chunks, allowing GPUs to conduct a multitude of complex mathematical calculations simultaneously. So, as a result, NVIDIA processors have been deployed in a wide range of applications, including cloud computing and data centers, which will act as hubs for many AI systems. The accelerating adoption of AI will play to NVIDIA's strength. So, and while estimates vary greatly, there is general agreement that the opportunity is staggering. According to a report by Bloomberg Intelligence, the generative AI market will grow from a $40 billion in 2022 to $1.3 trillion by 2032, a compound annual growth rate of 42%. The proof is in the pudding. So, a quick look at NVIDIA's recent results help illustrate a potential growth by AI. In its fiscal 2024 third year to $18.1 billion, a company record, while its diluted earnings per share soared 1,274% to $3.71. Those percentages were partially schooled by easy comps resulting from 2022's tax sector slowdown, but help illustrate the magnitude of the opportunity. Investors shouldn't expect the company's triple and quadruple digit gains to continue over the long term, but its ongoing growth should be robust nonetheless. For its fiscal fourth quarter, now underway, management is forecasting more record results, including revenue of $20 billion at midpoint of its guidance range, which will be an increase of 230% year over year. It shows that the AI opportunity is far from over. So there's more good news. NVIDIA is the undisputed market leader for chips used for machine learning, an established branch of AI, controlling an estimated 95% of the market, according to New Street Research. As default provider of processing solutions for AI, NVIDIA is well positioned to ride this secular tailwind higher. So the game's afoot. While the prospects of AI in intriguing, Nvidia has several other growth drivers up its sleeve. For example, the recent slump in the gaming market is beginning to turn. The global graphics card market for gaming is expected to grow from $3.765 billion in 2024 to $15.7 billion by 2029. A CAGR of 34% according to market research firm Model Intelligence. As a leading provider of gaming GPUs, this secular tailwind boosts NVIDIA as well. NVIDIA is also a leading provider of processors used to zip data through the ether and around data centers, with an estimated 95% of that market according to CFR research analyst Angela Zeno. The digital transformation shows no signs of slowing as companies shift even more workloads, business systems to cloud. So the data center boom will likely continue. The data center market is expected to grow from a $263 billion in 2022 to $603 by 2030, a CAGR of roughly 11%, according to Precision Strategy Intelligence Market Research. This is all shows that NVIDIA's chips are so much more than just the gold standard for AI. The products are also the semiconductors of choice for gaming, cloud computing, and data center markets. The 800-pound gorilla of GPUs. After NVIDIA shares notched gains of more than 200% in 2023, investors are naturally uneasy about its evaluation. But there is a catch. The stock is currently selling for 27 times sales and 65 times earnings. Lofty metrics that would seem to validate investors' concerns. However, those measurements don't factor in NVIDIA's triple-digit percentage growth rate. For a company expanding this rapidly, the more appropriate metric is to use the price-earnings ratio, which for NVIDIA is less than 1, the standard for an underpriced stock. For the S&P 500, the P&G ratio is more than 2, which further puts NVIDIA's valuation into the proper context. Given its dominant position in numerous growth markets, a strong history of growth, and its reasonable evaluation, NVIDIA is one stock investors should buy ahead of an expected loss range surge in 2024. So, okay, it's now 12 o'clock at night and I have to go to sleep. See you tomorrow night. Okay, bye bye, everybody. Bye bye.